Imagine waking up tomorrow and the news says World War has officially started. Markets crash, banks freeze, panic spreads everywhere. In that moment, the order of your investments could decide your financial survival. Most people think war only affects soldiers and governments, but history shows something very different. Wars reshape economies, destroy currencies, and quietly transfer massive wealth from the unprepared to the prepared. During every major conflict in history, one thing always happens. Some assets collapse overnight, while others quietly multiply in value as fear spreads across the entire global economy. The problem is that most people invest in the wrong order. They chase trends, buy random assets, and hope everything works out. In a crisis, that mistake can erase years of savings. Smart investors think differently. They understand that when uncertainty explodes, the rules of money completely change. Survival becomes more important than growth. In fact, history already shows a very clear pattern. During wars, money quietly moves through a predictable order of assets, rewarding those who understand the sequence. If World War started tomorrow, the smartest strategy would not be guessing the future. It would be following a simple order that protects your money before trying to grow it. This order is not based on opinions. It is based on how money behaved during the biggest global conflicts in modern history. And once you see this pattern, something surprising becomes obvious. The smartest investment during global chaos is rarely the one people talk about on the news. So in this video, we will break down the smartest order to invest your money if a global war suddenly begins. Starting with the asset that protects your survival first. The first priority in any global crisis is not profit. It is survival. And financial survival always begins with one thing. Most investors completely ignore during normal times. Liquidity, the ability to access your money instantly when everyone else suddenly cannot. During wars and financial shocks, access to cash becomes more valuable than many investments. History shows that during crises, banks can freeze withdrawals, markets close temporarily, and financial systems slow down. People with immediate access to money gain powerful flexibility. This is why the smartest investors always start with an emergency layer before touching anything else. Not exciting investments, not risky bets, just stability. Think of it as financial oxygen. You may never notice it during calm times, but when chaos begins, it becomes the most important resource you have. Once this safety layer exists, something powerful happens. Panic disappears, decisions become rational, and rational investors almost always outperform emotional ones. After liquidity comes the second layer of wartime investing. Assets that governments cannot print and currencies cannot easily destroy. Throughout history, one asset repeatedly rises during global uncertainty. Empires collapse, currencies fail, but this asset quietly preserves value across centuries. Gold has survived wars, revolutions, and financial collapses, not because it is magical, but because it represents something governments cannot easily create. During global conflict, investors begin searching for stability, and when fear spreads across markets, they often return to the oldest financial refuge in history. But gold is only part of the story, because once fear stabilizes, another group of assets quietly begins outperforming the rest of the market. These are commodities, the raw materials every country suddenly needs more of when conflict expands. Wars require fuel, metals, food, and energy. When global demand increases quickly, prices of these essential resources often rise dramatically. This is why investors closely watch energy and industrial resources during geopolitical tensions. These sectors often move long before headlines explain why. But the investment order does not stop there. Because the next stage of wartime economies creates one of the most powerful financial shifts investors can understand. When wars expand, governments begin spending enormous amounts of money. Not slowly, but at a speed rarely seen during normal economic conditions. This sudden spending does not spread evenly across the economy. It flows toward very specific industries that suddenly become essential. Defense companies, technology contractors, transportation networks, and industrial manufacturers often experience massive demand during prolonged conflicts. These industries suddenly become strategic infrastructure. Governments rely on them to supply equipment, technology, and logistics at enormous scale. As demand increases, revenues in these sectors often grow rapidly. Investors who recognize this early sometimes benefit from the economic shift. However, intelligent investors still move carefully because wartime markets are volatile and unpredictable. This is why the order matters. Protection first, stability second. Strategic growth only after those foundations exist. Many people reverse this order. They chase risky opportunities first and only think about safety after losses appear. But disciplined investors understand something simple. In chaotic environments, avoiding large losses can be more powerful than chasing fast gains, because once capital disappears, rebuilding it becomes difficult, especially when global markets remain unstable. This is why professional investors focus on resilience. Portfolios designed to survive shocks often outperform aggressive portfolios during crises, and something interesting usually happens after the early chaos of war begins to settle. Markets begin searching for the future again. Investors shift their attention from survival toward rebuilding, and this final stage often creates the most powerful investment opportunities of all, because after destruction comes reconstruction. And reconstruction requires enormous capital, labor, and resources. Another powerful force appears during large conflicts: inflation. As governments spend massive amounts of money, the supply of currency often expands rapidly. When more money enters the system faster than goods can be produced, prices begin climbing across the economy. This means that simply holding cash for long periods can quietly reduce purchasing power over time. Smart investors understand this trade-off. Cash provides safety and flexibility, but it should not remain the only asset during long economic disruptions. This is where inflation-resistant assets begin attracting attention from investors around the world. Historically, resources tied to the real economy tend to perform better during inflationary periods. These assets represent physical value. They cannot be created instantly with a printing press. This scarcity gives them a powerful advantage when currency supply begins expanding rapidly. At the same time, investors begin studying global currency movements very closely, because during conflicts, some currencies weaken while others strengthen depending on economic stability. Countries with stronger production, resources, and stability sometimes attract global capital, seeking safety. This movement of capital can quietly reshape financial markets during long geopolitical conflicts. But experienced investors do not rely on a single strategy. They build diversified layers designed for multiple possible outcomes, because uncertainty always remains high during global crises. And preparation is never about predicting the future perfectly. It is about building resilience before uncertainty arrives. Another asset class behaves very differently during major conflicts: real estate. But the impact depends heavily on location, stability, and long-term economic conditions. In unstable regions, property values may fall as uncertainty increases and people move towards safer areas. But in economically stable regions, real estate can remain surprisingly resilient during long conflicts. Housing, infrastructure, and essential buildings remain fundamental parts of any functioning society. Even during difficult times, people still need places to live, work, and operate businesses. This is why certain types of property connected to essential services often remain valuable. Warehouses, transportation hubs, and industrial buildings can become especially important during wartime supply chains, because large-scale logistics becomes critical when economies shift toward production and supply. Investors watching these patterns sometimes focus on industries that support logistics and infrastructure. But the biggest economic transformation often arrives after the conflict begins to end. History repeatedly shows that rebuilding periods can create powerful economic growth. Entire cities, infrastructure networks, and industries may need reconstruction. This process requires enormous resources, labor, materials, and capital investment. And when reconstruction begins, many sectors of the economy expand rapidly. For investors who preserved capital during the early chaos, this phase often offers the largest opportunities. At this point, something psychological begins happening across financial markets. Fear slowly transforms into opportunity for investors who stayed patient during the chaos. Because markets rarely move only based on facts. They move based on human emotions like fear, panic, and uncertainty. When fear dominates the environment, many people sell valuable assets simply to escape uncertainty. But experienced investors understand a powerful principle. The best opportunities often appear when emotions are strongest. This is why discipline matters more than prediction. Nobody can perfectly forecast global events. But disciplined investors follow structured strategies that protect them during uncertainty. And that brings us back to the most important idea of this entire discussion. The order of investing matters, because the smartest investors do not chase excitement. They follow structure. First comes financial protection, liquidity, and emergency access to money. Second comes stability. Assets historically trusted during uncertainty, like gold and scarce resources. Third comes strategic growth. Industries that expand when governments increase spending. Fourth comes inflation protection. Assets connected to the real economy, like commodities and resources. And finally comes long-term opportunity during rebuilding cycles after the crisis passes. This sequence may look simple, but its power comes from discipline. Because during global uncertainty, emotional decisions destroy wealth faster than economic events. But there is a deeper lesson hidden inside every financial crisis. Wealth rarely disappears. It simply moves from one group of people to another. History shows this pattern again and again. Panic sellers lose assets while patient investors quietly accumulate them. This is why knowledge becomes one of the most valuable investments during uncertain times. Because preparation changes the way you react when uncertainty arrives, and when millions of people panic, disciplined investors quietly follow their plan. Because true investing is not about predicting the future perfectly. It is about building systems that survive many possible futures. Wars, recessions, and crises have appeared throughout human history, but economies always adapt, rebuild, and move forward again. And investors who understand these cycles often position themselves ahead of the next transformation. So, if a global crisis suddenly begins tomorrow, the smartest investors will not panic. They will simply follow the order they prepared long before the crisis arrived. Protection first, stability second, strategic growth third, opportunity last. Because in uncertain times, the real advantage is not predicting the future. The real advantage is being prepared for it. Most people prepare for good times. Very few prepare for uncertain times. And that difference quietly separates reactive investors from strategic ones. Preparation does not mean predicting disasters. It means understanding how systems behave when pressure suddenly increases. And financial systems always behave differently when fear enters the environment. Prices move faster, liquidity disappears, and investors suddenly realize stability was more valuable than excitement. This realization often arrives too late for many people. But disciplined investors build their strategies before uncertainty arrives. They think in layers rather than single decisions. Each layer serves a purpose during different phases of economic change. Liquidity protects you when uncertainty begins. Scarce assets stabilize value when currencies weaken. And reconstruction opportunities appear when rebuilding begins. Different conflicts, different countries, but remarkably similar economic patterns. And investors who study these patterns gain something powerful. Because the goal of investing is not surviving one event. It is building resilience for an uncertain world.